Okay, no surprise here, guys. The Phoenix housing market is continuing to slide. And by sliding, it's not going up. So it is sliding in the wrong direction. But oddly enough, it is not sliding as much as we all think it should, or maybe feel like it should. Because remember, feelings make people want to act. And they usually do act on emotion, not logic. And right now, the emotion is strong. It is strong that the housing market is going to crash in Phoenix. But I'm just saying right now, the market, the data is not suggesting that it's going to crash. It's suggesting that it's probably going to continue to slide, a percentage point or 3 or 4 by the end of the year at this current pace. But the 20% crash, the 30% crash, guys, I think you might be waiting a long, long time. By that, I mean decades. But if you are taking a break here, if you are watching us today, please let us know where you're watching from. We love to curate our content for people watching more in-state or out-of-state, and the algorithm helps us do that by you participating and saying where you're watching from. If you could comment and let us know where you're watching from, or just ask a question, we'll have a two-way chat here like we did the last week and the week before that. That'd be great. I would appreciate that, because we're going to cover a lot more here today than just the housing market, guys. The local economy in Phoenix is on fire. Okay. Now, right now, Arizona is ranked. Arizona as a state amongst the 50 is ranked number 6 for future economic outlook and growth. Again, against all 50 states. Arizona comes in at number 6. Utah comes in, by the way, at number 1, and Arizona is number 6. So that is a very promising metric to go by. But we're going to jump in. I'm going to share my screen. We're going to go over a couple articles. We're going to talk about the housing market, guys. I found an article that really sums it up well right now, what's happening on a macro level. Then we're going to bring it back down to a micro level here, specifically for Phoenix, all backed by data, of course, and not just yours truly's opinion. So here we go. I'm going to jump in, guys. But again, please feel free to share your thoughts as to what you think about the information here as we go through it. But guys, check out this article. This is a great one. There's 4 graphs, 4 charts that we're going to break down really quick that I think is really good. And you're going to find extremely helpful, and it's going to make a lot of sense. Okay, but before we get started, I got to give a shout out to Rick. Thanks for watching here, Rick. I know you're on a different time zone right now, and I appreciate you tuning in. Thanks for saying hi. All right, we're going to jump in here. Why the housing market is so stuck in 4 charts, okay? Now, there's a lot of text here, okay? However, we're going to go right to the charts, and we're going to cover those 4 things because these are really good charts that make a lot of sense. Guys, number 1, home price growth has outpaced wage inflation. Now, you can see the median home price right here, and this is going back to 2021, or 20, I should say, right here. The median list price in America was $331,808. Now, as of the last reading here for this chart in 23, it was $426. That's a big jump. But look at the median household income right here. Look at the lines. That tells the entire story. So we all know the whole situation, that if median household income is not increasing by the same tick or pace that the median list or house value is going up in America, then there's going to be some problems in terms of affordability. And so that's what a lot of people are screaming from the mountaintops right now. It's going to crash because wage growth hasn't kept up. It's gone up in many states and cities across America, Phoenix actually being one of them that actually increased a decent amount over the past 12 months. But it's still being outpaced by house values and prices of homes. So it's making it very difficult for people to jump in and buy a house. But that is just one chart. Let's share my screen and we'll go into the second one, which I thought is also really good. Check this one out, guys. More than half of homeowners have a mortgage below 4%. More than half of homeowners in America have a mortgage below 4%. You can see this graph right here. So right now, you can see right here, you can see that it's 21.8% under 3% in America, 21.8. And then 3 to 4%, 33.6. Now, if you just roughly combine 21 plus 33 here, you're looking at about 54, 55% of homeowners in America that have a mortgage below 4%. That is wild. That's a reason people aren't leaving their 4% or 3% rate to go trade it in for another one. And then, of course, you can see the rest of it right here. But notice here that the height of the low interest rates was when you had the most people who got the refinances at the 3 and 4% rate. But now look what's happening. It's starting to increase and tick up because, of course, they're not offering rates at that number anymore. And so you're getting more and more homeowners, as you can see by this graph, that are at 6%, 7%, etc. So that is a big reason. Now, next, you have this graph, which is good. Supply is up, but list prices are not falling. Interesting. So you have this blue graph here where the active inventory was decreasing all the way through 22, 23, really, and then it started to increase and has been ever since for the last couple of years. But you have median list price also going up. Now, why would that be? Why do we have a situation in which you have active inventory increasing, which means people have more choices, but you still have this good amount of list price or housing value staying high? Well, a big part of that is going to be because you have so much equity that was increased so quickly by most homeowners from 2020 COVID on, that they don't have to sell. They'll just keep their high prices. If they don't get it, they'll have a canceled or an expired listing on the market. And they're okay with that because they're still not sure if they want to trade in that 4.25% or that 3.25% or whatever it may be interest rate for a 7% rate, because these people don't have to sell. Now, if you have a divorce, a death in the family, you have a relocation, things like that, where you have to sell, that's a different story. But again, a big portion of the population that would normally sell a home in America doesn't have to. So that is a big, interesting fact. Frank, what's going on? Watching from California. Thank you for watching and letting us know where you're watching from. 3.36 on a 15-year loan in California. Congrats, Frank. You're going to have a paid off home in less than 15 years. Even I can do that math. So thanks for sharing. Smart idea, assuming you can afford the payment, right? All right, let's go back to my screen here, because I have one more graph I want to share with you guys, which I think is just, this article is so good. It's so good, by Yahoo Finance. Buying has rarely been so much more expensive than renting. So buying a home in 2025 costs 43% more than renting one. You can see the historical averages right here, guys. Right now, the premium for 2025 is 43%. In 23, it was 49%. Now look at the difference in 2012. It was a negative 10%. So it was more expensive actually to rent in that scenario. So you have a premium above this mark, which is the historical average of 14%. So what this graph is saying is that there is an historical average where, even in what might be considered a good market or not a overpriced market, historically, the historical average was still 14% more to own or buy a house than it was to rent. But yet, why did people still choose to pay 14% more to buy a house, even in a normalized market, which I know we're not necessarily in right now, as opposed to renting? Well, they did because they understand the long-term play of equity growth and home appreciation. That is why. Now, I have a graph right here. In fact, I'm going to pull it off for you guys right here, because my desk I have all kinds of fun stuff, guys. This graph right here, I don't have it digitally, but I will get this digitally. See all the green on this graph and a little bit of red? Okay. Now, that's going back to 1950. U.S. housing prices from 1950 to 2024. This graph right here, okay, shows a lot of green. And what this shows, guys, is since 1950, there have been 7 years. That's it. 7 years from January 1st to December 31st, a calendar year in which home prices were negative for the given year. That's it. Since 1950, 7 years. That's it. The biggest year was 2008 with a negative 11.9% appreciation. And then, of course, you had some big years like 2021 with 19% appreciation. And then you had other big years across the board as well. So that's why the average person will choose to still pay the historical average of 14%, a premium above renting a property when it comes to home ownership, because all the benefits it gives you in the long term. But the hot buttons right now for most people isn't a long-term growth. The hot button right now is trying to time the market, and don't buy now because it's expensive. And if it goes down further, you can time it a little better, get a little better price, a little better terms maybe on your payment, and then you're better off even if you hold the property 5, 10, 15 years. Well, that is true. That 100% is true. And maybe right now isn't the best time for you to buy. Maybe it is. So it depends on everyone's situation, because it's all case specific to that point. Man, what's going on? So my 2.25 30-year home, took the money, moved to a smaller, better place, paid cash. Nothing better than no mortgage. Amen. Well said. That's another benefit of home ownership, guys. You get this kind of appreciation over the course of 30 years. Holy Moses, right? You will make some money if you stay the course, paying down your mortgage every month, and then you'll cash out one day like Mana did, M-A-N-A. Hope I pronounced that name correctly, Mana. And now you own a home free and clear. Congratulations. That's what that jazzes me up, because anybody can start wherever they are today, being poor, living in a van down by a river, And if there's some way you can get educated and work with baby steps towards saving some money, getting educated on how you buy a home somewhere, somehow, get in the game. Once you're in the game, then over 50 years, I should say 74 years, look what happens over 74 years. Okay. So that is my encouragement to you guys today. But I know you came for more than just that on this show today. Your time is valuable. I'm going to deliver on some more fun stuff for you guys. So let's go micro now. We went macro. Let's go micro, and let's talk about the Phoenix home market. Let's talk about the market index here with the Cromford report. You're looking at right now 71.9. It is continuing to go down. That's why the housing market is sliding. It's been in the 73s, 74s. Now it was 72. I think last week, 72 and some change. Now it's at 71.9. That is not good. A buyer's market is below 90. Clearly, we're in a buyer's market, which means if you have the means and you so choose, buying a house in a buyer's market is usually a good thing. That's why they call it a buyer's market. Even I know that. But there's more to this story, okay? I want to share with you this article that's kind of interesting because it makes a lot of sense. Here we go. The overall picture is discouraging for sellers, but enthusiastic for buyers, and as they are in a very strong position. Lots of choice and thousands of motivated sellers who are ready and willing to make a deal. This is not just for resales, but most new home builders are anxious to sell and are willing to make some brilliant offers when it comes to buying down your mortgage interest rate. We have not seen such a favorable situation for buyers since March of 2009. Now, I'm going to repeat myself one more time on that. We have not seen, this is Cromford Report saying, who is a local authority for housing data in the Phoenix area. This is them saying they have not seen a more favorable market for buyers since March of 2009. So now I sit there and I get comments on social media. You just want to sell some houses. You have a hidden agenda. What are you talking about? It's a terrible time to buy. Now, why would you say that? Would you say that if you believe the market's going to crash further, right? And go down further? And I'm not saying it's not. It could. And so if you can time that market perfectly, kudos to you. I want to ride that wave with you. Give me your advice, please. I'll take it because I would love to buy at the very, very bottom. But who knows when that will be? There's one thing for sure. I know Ryan Serhant, shout out to Ryan here. He made a comment here on social media recently that he said that right now is a favorable time for purchasers to buy. It's favorable because you can dictate terms and you get favorable terms. But when interest rates come down, and guys, don't kill me on this, please, because I'm not saying they're going to come down next month or even 3 months or 6 months from now that are going to make an impact. But when they come down to make somewhat of an impact, which could be a full point somewhere in that ballpark for at least Phoenix, that could be in 3 years. I don't know, but it's going to happen. It's cyclical. We talked about this last week. But when that happens, what also will happen? Well, buyers will jump more into the mix. More competition doesn't mean prices are going to go up all of a sudden, but you may have the ability not to dictate terms as much with motivated sellers. Why? Because let me tell you that four-letter word that sellers love, that as a buyer, you really don't want. It starts with a, not an F, an H. Okay? Get your minds out of the gutter. An H. Hope. H-O-P-E. And if sellers have hope, even though it's not necessarily happening right now, but they have hope that in the future, 1 month, 3 months from now, the market will get a little bit better if they just hold it out, then you won't be able to dictate as good of terms, generally speaking. So just keep that in mind when you're trying to figure out what it is your plan might be for what you want to do buying a property. Now, back to the article. The fact that PV is now at the top of the table reflects the current strength of the stock and crypto markets, guys. What's he talking about? PV top. Here's what he's talking about, guys. Look at this. PV leading the charge, and that charge ain't too impressive. Look at all the red on the table. Guys, this is not showing a healthy housing market. Buyers, listen up, okay? Because if it's not a healthy housing market, then that means you can jump in if you want. If you want to, again, ride the wave down further, because that's you're at the casino right now in Vegas, and you're waiting for that 7-Eleven on that first roll to come out, right? So you can make some money. Then this is what you want to see. You want to see more of this, so it will go down further. But if you are watching this and you look at this and go, holy smokes, PB is the only one that went up. Why did PB go up? Well, this is what they're talking about right here, because the current strength of the stock market and the crypto markets. Unfortunately, The relative weakness, Cronfer goes on to say, of the bond market is still making it unlikely that we will see a substantial drop in mortgage rates in the short to medium term. We need a 10-year Treasury bill to attract far more buyers for that to happen. Don't blame the Fed. They do not control the price of the 10-year T-bill. With the U.S. dollar on a powerful declining trend, the usual appetite for foreign investors for T-bills is much weaker than normal. The silver lining is that Arizona real estate is getting a lot cheaper for foreigners. For example, a buyer in Great Britain for British pounds, I am looking at a 10% discount as a buyer from Great Britain this June compared to January of 05. 10% discount on U.S. real estate. Why? Because the dollar is weak compared to some foreign currencies right now. And they talk about the Swiss franc, of course, and then even China. But China is not longer very enthusiastic, they're saying, on U.S. real estate anymore. But Canadians, they are looking at a 4% discount compared to January. So I think we need to look to domestic buyers who see a recovery in demand. So guys, the bottom line is that you can't have international buyers, especially Canadians, save us, which in some markets like Scottsdale, PV, it has once upon a time back in 2011-10, we were coming out of the rut because the dollar was so devalued. Now that the dollar is getting more down in that neck of the woods, not that far, but it's being cheaper now for foreign investors to actually purchase U.S. real estate, which could be great. But again, there's not that many of them, especially in Phoenix. So we need to continue to work on local investors and U.S. citizens looking to buy second homes and move to Phoenix. And how do we track them? But before we go there, I want to show you this article because this is interesting, right? This article talks about the U.S. Treasury first real quick at 4.296. Look at where it's been since, July of 22. Look at how it's been up. Now, why do they have to offer such a high yield on that? They have to offer such a high yield because the demand for U.S. Treasury bills, like Cronfer said, has been lower over the last couple of years. And if it's lower, you got to offer a higher rate so people want to buy them. And by doing so, the 30-year fixed as one mechanism stays higher as well. So that's what we're trying to accomplish here. That's what we're talking about in this example. But if I go back to my article here and I show you this article, this is interesting because where do the international buyers come from in Phoenix or the U.S. in general? Well, this article talks about international home buyers and how that looks or what that looks like. You can see right now that Miami, New York, and Los Angeles top the list. Canadians reign the largest group of international home shoppers at 34.7% across America. But guys, did you know, this is interesting, Phoenix, you came in at number 8 at 2.27%. Now, number 1 is Miami at 8.66, and it drops all the way down to New York City at 4.9. So guys, at 2.27%, that's not too shabby. So congratulations, Phoenix. You actually are number 8 on the entire list of all cities in America for international home buyers. Who would have thought? That number is increasing as well. It's increased over 1 percentage point over the last several years as more international home buyers find other places like Miami, New York, LA, a little less affordable. That's that key word again. So they're coming to Phoenix for that reason, as well as the accessibility to major ports and the West Coast like LA and San Diego. So congratulations, Phoenix, for making that list. We will continue to attract more international buyers, my prediction is, over the next 10 years, especially with the TSMC, Taiwan Semiconductor Manufacturing Plant, who's contributing $165 billion to their facility to make semiconductors right here in Phoenix. So more to come on that in the future. But this is a very cool article. So more information here. All right, let's go over to, you saw this is not good, right? All that red. Let's go over here to the number of price changes. That's interesting, right? The number of price changes per week, they probably have skyrocketed, right? Well, they actually haven't. Look at this, guys. They're right here, which it's not low, it's high. A lot of sellers are cutting their home prices, but they're not fully realistic yet. You have 3,372 price cuts compared to just, back in April and even in April, early April in 25 and in March, there were more price cuts than they are right now. Well, why is that? I mean, the question should be, shouldn't sellers be getting more realistic at this point and therefore pricing or cutting their prices even more because the market is in a decline mode? Well, yes, but here's the thing. Sellers are also more realistic now than they were in March and April before they had to get their teeth kicked in a little more because of the reality that we are not in the same market we were a year ago or even 2 years ago by any stretch of imagination. So now they're getting more realistic. So hopefully the amount of price cuts will be less and less because they're pricing their home from the get-go at a number that's more market value, if you will. That comes down to education. That's why I do a show like this. That comes down to agent education so they can tell their clients as well. And of course, flat out reality. That's where it comes down to. And sometimes people are not wanting to address that. Frank, what's going on? Is the Phoenix Metroplex facing home insurance issues similar to California and Florida? Okay, now issues similar to California and Florida. This is a great question. The answer for insurance issues, no, not like that. But are insurance premiums going up across the board in Phoenix? Absolutely. And I know this to be true because I own rental properties in multiple different suburbs across the Phoenix area. And you'd be surprised how much insurance can increase between a suburb of Glendale and a suburb of Gilbert, let's say. They vary. And of course, the value of the home matters as well. But like, I'll give you an example on a property that I own that's about $350,000 in terms of value today. That premium went from being about $780 a year, I know, up to about $1,550 a year. It doubled in about a year's time. Now, I had another one that went up about 40%, another one that went up about 70%, but that one went up about 100%. And so it's crazy. Now, at the end of the day, if I'm only paying $75 a month for insurance on a rental property, it's worth $350. That's a pretty good deal. So if it goes up to $112, $110, $120 a month, it's not the end of the world. But for somebody who's an investor where their cash flow margin is tight, that's rough. Or if you live in the house and it goes up that much, and maybe you're on a fixed income, that can be tight too. So my heart goes out to those people, and unfortunately, it's pooled risk. And so with what's happening in the natural disasters of Florida, Texas, and California, now coming over to Arizona, we're hit a lot by that pooled risk. So insurance is going up in Arizona. There's no two ways about it. So you just have to make sure you underwrite that and factor that into your monthly payment when you're looking to purchase a property. And that's a big reason, I think, if you go back to this article right here, that's a big reason why the premium now is 43%. Now, obviously, it was more here, but rental rates are starting to go down, causing this gap to be even wider. So great question, Frank, and thank you for asking that one, because that's a legitimate issue when it comes to someone paying their monthly payment. Tara, thanks for chiming in here. Let's see here. Would you be able to tell me if I have my home priced too high? I would love to, Tara. Give me a call. The number's on the screen right here, 480-660-5974. There's two things in real estate, personally, guys, that I feel I do the best, right? The things I enjoy the most, and I feel I'm really good at, without bragging. I've been doing this 20 years, and that is valuing and pricing homes and negotiating on behalf of my clients. I love it. And I love it because for too many people, negotiation in real estate, it means with realtors that for me to win, you, my other realtor on the other side, has to lose. For my client, if I'm representing a seller, to win, the buyer has to lose. And that's not true. That's not true by any stretch of the imagination. And so my goal is to work from a very collaborative standpoint, but still being very firm and choosing my words very wisely to posture position my clients correctly so that they get the best deal at the end of the day when it's all said and done. So anyways, thank you for asking that question, Tara. If you reach out and call that number or hit me up on social media at Kelly Cook Homes, on Instagram at Kelly Cook Homes, then I'll be sure to get back to you on that. I would be honored. Okay, now I got some other good stuff to go over, guys. So stay with me, okay? Let's go to this graph right here. Now we were just talking about price cuts, but let's check out the median sales price in Phoenix, guys. We are micro again. We're focusing on the micro in Phoenix, and check it out, guys. Here we are. We're back down to $451,990. So as of early June, okay, we were at $451,990, and now we are still, we're holding tight, I guess, right? We're at 449, went to 451,990, and I guess we're still holding tight. That reading is looks like it's going in the wrong direction, but we're right about 451, call it 452, okay? So it's holding pretty tight. We saw a big dip from, what's this, March all the way down to April, then it bounced back up in May. And so here we are right around the 450 mark, okay? So there's not a big fall off here. Now, if you go back to this article here and you see where the U.S. home prices are going, meaning list price, look at this. Now, obviously, it's flattened off here a little bit in 23 and 24, but now on the micro side here, we are holding fairly tight, even with supply going through the roof, okay? So if there's anything to be positive or optimistic about, that's it right there. The median sales price on a monthly basis is holding fairly steady around that $451,000 to $452,000 mark. And it's been that way up and down a little bit for the last several months. So we're not seeing this crash. And again, guys, please understand the median. The median is not the average. So even if you have a $16 million home record or a $25 million home record, like I'm going to show you here in just a minute, okay, that doesn't necessarily skew it that much. Why? Because the median takes the middle. If you have, 26 homes, 27 homes sell, right? I'll do math even easier for myself. 31 homes sell, then whatever sold on a spectrum of prices at number 16 is the median home price. Now, obviously, a lot more homes sell than that. That's why the median list price is very accurate in Phoenix, because we're talking 5,000, 6,000, 7,000 homes selling on a monthly basis in Maricopa County that this is pulling the mean from. So you're talking a large sample size, which makes the median actually fairly accurate. The average can be skewed by luxury home sales for sure. That's why we focus on the median, okay? Just to make sure I get that out, as I get roasted on social media sometimes for people saying, I'm using the median. That's the most accurate number you can get with a big sample size. It's pretty accurate. So, all right, now let's go over to a couple articles here. I'm going to show you what's going on around town in the Phoenix area, because, guys, local economy is doing pretty well. Now, here's the luxury home market, okay? Not everyone can afford a house like this, unfortunately. Very few people can, but it's happening when they're going on the market. Some of these are selling. $25 million Scottsdale home sale highlights the luxury boom, and there's a picture of it. What's the square footage? Almost 15,000 square feet. And it sold in Silverleaf. Now, where is Silverleaf? Silverleaf on the map here, guys, you can see a Scottsdale Air Park right here, runway. And so Silverleaf is right up in the canyon. If you go right where my cursor is, right through here, there's Horseshoe Canyon. This whole area is Silverleaf right here, which is a portion or part of DC Ranch. And you have the Horseshoe Canyon. Then the awesome one is the Upper Canyon right up here, which is just absolutely spectacular. I have a friend who lives up there, and he has just almost a spectacular view dead on with the Scottsdale Air Park runway. It is gorgeous. You are elevated. You have amazing views and bigger lots, and it's just a really cool place. So $25 million will get you a house up there. Up there in Silverleaf, and congratulations to that home seller and buyer for purchasing a beautiful home in a beautiful area. Okay, now moving on, I'm going to show you a couple more things here, and then we are done. Okay, so stay with me, guys. But we're sticking with Scottsdale. Scottsdale's blowing up right now in terms of the local economy on the residential real estate side and the commercial side too. But you have an 88-unit luxury condo project set to begin construction in Scottsdale. Now, where is this at? This is part of the One Scottsdale Master Plan community. Okay, so this is coming out, and where about is that? Well, let's go back to our kind of center place here, the Scottsdale Air Park runway. It's kind of easy to see. And you go north, there's the 101 loop right through here. You go north right there. Here's the 101s. Here's Scottsdale Road where the red dotted line is. And you can see right here, this is a pretty cool place. They're calling it the corporate corridor of Scottsdale, right? Here's the 101, here's Scottsdale Road, and here's all this construction happening. There's more construction happening than just this, but you have some apartments, you have some mixed-use space, and you have some more condos and office and retail coming right to here. You have the old Dial Henkel building right here, which is a actual very cool architectural building. But this whole area, this long rectangle, is going to be pretty special when it's all said and done. Okay, so what do you think about all this development in Scottsdale? There's a lot happening, and it's going to cause a little more strain on traffic flow right through there for sure as well. Timothy, what's going on? Homes in Phoenix are 50% overpriced considering a 20-year average growth rate. So expecting only a 3% correction is not realistic. We need a minimum 10% correction before the high-income people buy. All right, Timothy, I'm going to challenge you really quick, okay? You good with this? I want to hear your opinion to a rebuttal to what I'm going to show you, okay? I'm going to show you this in real time. So 50% overpriced. All right, let's go back to the Cronf report. I'm going to show you guys this. I showed it to you last week, and I don't believe Timothy was on. Maybe you were. But I'm going to show you this, guys. This is interesting, okay? Let me go to my observation here, and let me see what I can get to Timothy to reply. Okay, ready? Here we go. This graph right here. I'm going to share it to you. Here we go. Boom. Ready, Timothy? Let me know. Holler at me. What do you think? 50% overpriced. What this graph is showing you, Timothy, right here, is that over from 2000 to 2025, okay, even with the ups and downs, which is the Cromford median home price in the blue. See, here was the up before 05, 06, and the crash, the Great Recession in Phoenix here, all the way down to $113,000 for a median home price, okay? and then back up, and then spiked during COVID, and then back down, and here we are today. Where we are today is a median home price of $450,000. Now, what this green line is showing you is that the average appreciation rate on the median every year in Phoenix over the 25-year time period was 5.3% appreciation every year, median every year. If you take a 5.3 per year appreciation rate, even with the ups and the downs, the big downs, big ups, you get to a median home price of $450,000. And when they had a reading here on this one, it was at 444. It was actually under where it would be if it was a straight line, no crashes, no big run-ups. It would be almost right where it is, actually under by about $5,000. Okay. So Timothy, I'd love to hear what your response to that is. Okay. Because again, we feel like it's overpriced because we were way down here and then it came back up, and then we went spike on COVID and it came back down. Okay. So I would like to know your thoughts. Okay. Thanks for commenting. Okay. I'm not trying to argue it, but this is a healthy debate because I think a lot of listeners would appreciate this. Okay. Listing prices are high because of a homeowner can get a 100% rate of return on a home they purchased in 2021. They will try because they know a 20% correction is coming. Then they will buy back in. Listing prices are high because a homeowner can get a 100% rate of return on a home. Okay. Yep. Because it went up. Yep. They will try because, yep. All right. So what you're saying is that they believe prices are high. So they're going to sell right now, take the money off the table, and then buy back in after it crashes and goes lower. That could happen. That could happen. But to say home prices right here earlier are 50% overpriced considering a 20-year average year growth. If you don't say they're overpriced based on where they were in 2019, okay. In some cases, that is somewhat factual, right? There have been some run up in certain areas. Now they come back down a little bit, but that's okay. But based on a 20-year average growth of rate or rate growth, that's not true because I'm showing you the actual facts right here over 25 years. Okay. And prices are right where they should be based on an average real annual appreciation rate that's on the median side, of 5.3% year over year. Just saying. Okay. So, but to your point, is somebody willing to potentially sell right now and take money off the table because they bought in 21 and it had a big run up? Absolutely. And they're going to do well at this time. But to your point, if a lot of people don't do that or they don't have to sell, then what? They don't have to sell. They'll just hold on and wait. Can't let the house go off the market. Then they'll eventually maybe sell if they can't get the number. If they can't get the number, which right now they probably can't get their number because a lot of home buyers aren't choosing to purchase because they're waiting for a larger correction. Then you have this standoff, right? This someone's playing chicken and who's going to blink first. And what negates all that game of chicken when the buyers have the leverage, what negates that game of chicken is if economic conditions change, meaning rates change, they go down. And again, it could be a long time from now. But when that changes, they go down. Good economic news on tariffs or whatever it may be, right? There's a lot of things that could change that game of chicken at some point. And that's what we're going to be tracking for you guys every single day. Okay. We're almost done with this. So hopefully that was a good debate between me and Timothy. I appreciate you chiming in on that. I really do. Okay. A couple more. I want to show you this, guys. Minnesota developer requires 217 Phoenix acres at a state land auction. Now this is right here. Okay. If we go back to my map, we're talking about one Scottsdale right here. Here it is on this side of the road. Boom. This little area right here of desert land. And you can see it, right there. That's where the Phoenix Coyotes, Arizona Coyotes, actually tried, the old owner tried to buy this land and propose putting the new home of the Arizona Coyotes. Unfortunately, he wasn't able to buy this land because they wouldn't go to auction soon enough for him to purchase it. And he had to make a decision. And he sold the team for $1 billion. $1 billion, right? There's my Dr. Evil impersonation. And he left. Okay, so he made out like a billionaire, which he already was, I'm sure. And team went to Salt Lake City, and now we have no professional NHL hockey team in Phoenix, which kind of is a bummer. But hopefully within 5 years, we still retain the mascot, the rights to the Coyote name, all that stuff. So hopefully in 5 years, some other person comes in or a group of wealthy people come in and they buy to bring back hockey to Phoenix because, guys, hockey's cool, man. I don't play it, but I love watching it on TV. It's even better watching it in person. And if you can't watch it in person, which you can't anymore unless you want to get on the plane and fly somewhere or drive, that kind of stinks, right? So hopefully that changes in the future. But we got a couple more articles to cover here, and I want to bring it home for you guys. Scottsdale's on fire, guys. The park developer is formerly Next Scottsdale Mixed-Use Project. There it is in Old Town Scottsdale at 5th and Goldwater, guys. This is prime real estate. You're talking Old Town Scottsdale right here. And right over the canal, right in this area off of Goldwater Boulevard, and here's Scottsdale Road right on the middle where my hand is. There's Goldwater. It's kind of the expressway over on this side, and then you drink water with the expressway on this side of Scottsdale Road to avoid all the traffic. But right here, man, they're going to put that nice project, right there at 5th and Goldwater. So that is coming as well. So more development happening in Scottsdale. All right, now this is a big one. Diamondback Stadium renovation bill finally passes, and governor is expected to sign off on it. Now, this is Chase Field in downtown Phoenix. Now, what this article goes on to say is that the city finally passed a referendum or bill to keep the Diamondbacks here in Phoenix. That is a blessing. That's a good thing. Now, Chase Field was initially built in 1998, and since then, no major renovations have been done to it. So now it's 27 years old. So there's a lot of structural components that need to be and things that need to be done to Chase Field at this point that the city officials have been saying they need to get done. So the government passed, the local government here passed a bill, and that bill says that the taxpayers will not be on the hook for any more than $500 million for all of these renovations. And the owner has to put in $250 million, or the ownership group, $250 million of their own money to contribute to this as well. And none of that $500 million can go towards luxury suites or luxury upgrades to the stadium. That's come out of the pockets of the owners or private money. So that is a great thing for Arizona to keep the Diamondbacks right in downtown Phoenix. And by the way, that stadium is actually really nice, in my opinion. Now, I don't go to a ton of games, but it's really nice. So what it'll look like with $750 million plus done to it in the next X amount of years, wow, it's going to be pretty special to be a Diamondback fan at that point. Wow. So looking forward to that. Good job keeping the Diamondbacks here in Phoenix. Oh, and the biggest part about this whole thing is that part of the deal with the city said it's off limits for them to move or shop the Diamondbacks to move them outside of Phoenix with the money being spent on the stadium. So they're going to be here for the long term, which is great news for our local economy and sports scene. Okay, wrapping this up, guys. A couple more things. Let's show you this here. This is just saying that summer plans, guys, a lot of people travel, okay? And this is saying that most Arizonans are opting out of European and international travel and vacations and actually staying domestically somewhere in the United States, heading up places like Minnesota and Wisconsin, Chicago, places that are, Washington, Idaho, that are a little more cooler in the summertime than, of course, the desert. And so this article is a good one because it's sharing that travel patterns are not going across the seas, which overall is good for, I guess, local when it comes to the United States economy, keeping the money right here. But us Phoenicians have to get out of the heat, right? So we have to go somewhere in summer for at least a little bit of time and get a little bit of reprieve from 110 when that happens here in the summer. Yeah, if you're watching from out of state, it gets hot in the summer. We're not bad. Today's like 101. It's beautiful. Actually, 101 feels actually pretty cool compared to 110. So we're thankful for that here today. All right, let's cover mortgage rates, and we're out of here, guys. All right, mortgage rates, real quick. You can see they are at 6.82, so they come down a little bit. They've been hovering around 7% for a long time. They're most recently up a little bit. They're down at 6.82%. That is a great thing, and hopefully they continue to go in that direction, inching ever so slowly back down. If we can get down around a 6% rate in Phoenix, speaking locally alone, for the demand and supply we know we have on the fence, man, that would do wonders for our local housing market. It really would. 5.99 psychologically, even though it's like 1/100th of a point less, that would be amazing because of the 5 being in front as opposed to 6.00. So hopefully that's coming. We'll see. But if you stay in touch with us on this show, you'll be fully informed. Every week, we're coming live at 4 p.m. local time here. Everything Phoenix, giving you the latest and greatest of the local economy and, of course, how it all ties to the greater picture of the macro economy as well, to know exactly what moves you got to make for the Phoenix housing market. All right. So, Frank, thanks so much. Another great show. Appreciate you, Frank. And then Tony, one street near my parents in Avalon, near Arcadia area, has 4 homes listed for sale and 2 for rent. Seems like people are trying to sell rent more in that area. Okay. Yeah. And what are happening to rent? Good point. What are happening to rental rates? Anybody remember from last show? They're holding fairly steady in Phoenix, but overall, nationally, they're creeping down too. So hopefully Phoenix stays as somewhat of an anomaly and they stay fairly flat. for us landlords out there or whatnot. But if you're a renter, you want to come down to a little bit, they probably will. They probably will creep down the next couple of months because it's summertime and it's just kind of slower altogether. So you might get a better deal on that if you wait another month or two, possibly, but maybe not. They've been holding steady at about $1.37 a square foot across the whole Phoenix area for the last 3 years. So not sure if they're going to move much at all in the near future either way. But great point. And thanks for saying that, Tony. I appreciate you. Guys, if you're catching the replay, comment below. Let's get this conversation going. And until next Monday at Monday, don't say that. Tuesday at 4 o'clock. Keep it classy, Phoenix. We'll see you next Tuesday at 4 p.m.